Hi, and welcome everyone to today's conversation on the Global Asset Monitor. At Ocorian, we're deeply focused on supporting asset managers across their full investment lifecycle, from capital raising, investor servicing, to governance, fund operations, and regulatory compliance. And that is why we produce the Asset Monitor, to help clients and the wider industry understand the forces that are shaping capital flows, valuations, investor demand, and fund operations. This third edition takes a global perspective, with particular attention to the US, which is the largest and most influential asset management market. And our aim is not to just share data, but to frame strategic questions that matter for our clients and asset managers. Who will control the flow of capital in the years ahead? How will regulation, technology, and consolidation of both sponsors and providers reshape private markets? How can managers adapt to an environment where scale, distribution, and operating resilience are competitive advantages, and themes like that. So with that in mind, we've got a great panel of experts. But before we get going, I would like to invite Mark Baker, who led the research for this edition for Ocorian, to give us a quick overview of the results before we open this discussion to the panelists.
Thank you very much, Yegor. Well, I'm going to quickly outline where we think global asset markets have gone so far in 2025 and some of the things that have shaped that. I'm going to look out a little bit towards 2030 as well and tell you where we think asset markets are going by then, particularly private asset markets. And then I'm going to hand back to the team to discuss some of the forces that are shaping all of these big trends. So let's look at the big picture first of all. So by early September this year, we model the value of the world's overall investable asset base having reached a record $267 trillion. That's up about 24 trillion since January alone. And if you look from the low point, which is just about when the US administration was issuing its tariff announcement, it's up about $42 trillion since that time in April earlier this year. It has been a bit volatile this year. That volatility has been real, but the market has sort of climbed the wall of worry and has reached these new highs. Of course, public markets are much, much larger than private markets. They've done most of the heavy lifting. Listed equities up about $12 trillion this year, about 10%, to around $125 trillion. The interesting nuance, I think, is leadership. The US market has added heft simply because of its size, but it has actually lagged its peers this year, as many of you will know. Europe, the UK, Japan, developed Asia have taken back some of their share of global capitalization. Of course, the world's largest companies still remain almost all American and account for about 18% of global market value. And that's really only a touch down from the beginning of the year because they performed so well. But turn to private assets, and we can see that private markets have also advanced quite well this year, totaling now about $14 trillion, up about 9.6% year to date. Private equity, in particular, is the largest of those. It's about $750 of $10 trillion, up about 10.8% this year. And what I think is interesting in the trend in 2025 is that Asia has done a lot of the heavy lifting. It's accounted for about a third of the growth in private equity, according to our modeling, lifting assets about 16% or so to around $2 trillion. Of course, North America is still the largest private equity market. It dominates in absolute size, but we think the growth rate has been a bit slower in 2025. Nevertheless, at 5.6 trillion or so, the US private equity market is still at a record level for 2025. If we look at the wider private asset space, the picture is resilient, but there are some contrasts. Infrastructure, for example, also up 10%, around $1.3 trillion, supported by long duration liability matching demand from the investor base. Here, Europe is actually a sort of key destination for capital and is sort of outsized relative to the size of its economy, particularly with that demand for sort of infrastructure investment across the continent. Fundraising has picked up this year. It's still taking longer than the glory days, but we have seen market participants reporting stronger fundraising. Turning to the real estate market, that's up about 3%, much slower than the other sectors, to around 1.4 trillion. but fundraising has been slower and refinancing pressures are lingering where assets were bought or leveraged to ultra low interest rates before the pandemic, or even during the very low rates in the pandemic period. And then private credit, which is a particular interest to us in this latest global asset monitor. Debt markets really deserve special attention, I think, because they connect financing conditions to valuations across a whole range of different asset classes. Obviously, the sovereign bond markets are the biggest debt markets and ultimately drive pricing across all credit. And they're up to $69 trillion, about 8 to 9% this year. And most of that's actually, of course, due to heavy issuance from governments that are borrowing with abandon. There is some currency effect in there as well. On the other side, on the corporate side, a hot market for corporate bond issuance, where companies are really trying to lock in at fixed rates on low spreads, means the corporate bond market has also grown significantly this year, up to about 39 trillion, also a record, about 11% year to date. And spreads are historically tight. That, of course, flatters risk assets in the short run, but it does raise questions about the balance of risk and reward as the economy potentially cools. Now, if we look at the private credit market in particular, that is obviously skewed towards corporates and not to sovereign borrowers, and that has continued to expand as well. We think that's up 7.7% year to date to about $1.4 trillion in assets under management by early September. North America easily takes the largest share of the underlying assets in the corporate bond market, the private corporate credit market. Yields remain very attractive, routinely above to 10% in senior secured deals, according to research by KKR. But the compression in spreads there is also notable, again, favoring the borrowers. Most private credit deals are about 80 to 90% are on floating rate, but that spread, it really matters for the cost of financing. Okay, so let's look at what's underpinned 2025's valuations. The yield curve, sovereign yield curve, particularly the US, but many developed markets, has obviously steepened, and for good reasons. Expectations of policy rate cuts have pulled down the front end, and corporate spreads have narrowed to lows that we've not seen across this cycle. That combination usually signals an easier landing for assets rather than signaling funding stress. It typically means, when we've seen this happen in the past, that we don't see a spillover into negative impacts for equity prices, despite that steepening yield curve, and therefore also private asset valuations. And that seems to have been the case so far in 2025. Ultimately, for private assets, real yields matter most for discounting those future cash flows. And as recently as the middle of August, the real Treasury inflation protected securities were showing real yields really low at about 1.9%. That is higher than the lows that they've ever been at, but it is still pretty tight considering where some people think inflation might be going in the US. And the adjustment has actually been quite gradual. So in short, I think the discount rate headwind has moderated without sort of really slamming financial conditions, and that probably helps explain why both listed and private equity valuations have held up this year. I think it's worth noting that there is a lot of risk potentially out there. Assets of all kinds are frequently reported or discussed as being priced for perfection. So if an incipient slowdown in the US really does intensify and inflation does pick up, as some suggest it should, from the tariff pressures, then potential stagflation could present a bigger danger, and that might knock asset valuations, clearly knocking over into the private space as well as the public space. That having been said, obviously there's always a short-term weather, but what's the longer-term climate? And for there, we remain at Ocorian pretty positive about the outlook for private markets. Our central case for 2030 uses fairly conservative return assumptions and pretty steady inflows. And it still puts private asset funds at about $24 trillion by the end of the decade. That's up about 70% from the 14 trillion that we reach in this September. Within that, we think private equity is going to rise about 3/4 between now and the end of the decade. So the thesis, I think isn't really a return to the golden years of the 2010s, where ultra low interest rates sort of pushed up asset valuations, but it's much more about private market structural role in financing. If we look at listed markets, the shrinking pool of listed names um, suggests that, and even with the recent success of some initial public offerings, suggests that there's no reason to expect that companies in need of capital are suddenly going to turn to listing on a stock market as their first port of call. Now that private equity is increasingly available, it offers the freedom from short-term market pressures, the freedom from reporting requirements. It offers the active operational support that portfolio companies within private equity funds receive. It gives them flexibility over capital structure across the equity and debt tranches. And of course, it provides the potential for management equity upside. All of those things mitigate in favor of the actual need that those who are looking for capital to stay within the private space. And I think that supports our long-term view on where the total valuation of the market's going to go. Finally, just a quick read on US industry sentiment from a survey that we conducted at Ocorian of industry practitioners earlier this year. Fundraising is reported to be a little bit harder than in 2024. More due diligence from limited partners and a bit more caution on risk appetite. There's a lot of concern about regulatory uncertainty across the market, and that is shaping decisions on where firms want to actually domicile their new funds. There is more outsourcing expected, using more specialist service providers like Ocorian to help funds manage their assets. And I think the other comment that we've noticed particularly standing out is that exit markets remain choppy. Managers are pretty split on whether continuation vehicles will stay central, and I think that's a topic that we might come to in a few moments, or whether traditional exits are going to reassert themselves. But there's certainly a clear conviction that pensions and family offices will be the most important sources of incremental capital. So to wrap up, I think 2025 has been a year of pretty strong price swings, but it has also meant good progress. Public markets have rallied despite all the policy noise, and private markets have continued to accumulate capital. Infrastructure steady, real estate's maybe a bit cautious, but private credit is growing even in a tighter spread world, or perhaps thanks to a tighter spread world. The macro plumbing, yield curves, real rates, and credit spread have been supportive, but there are also clear risks. I think we're positive about the medium-term outlook. It's constructive for private assets, but there is a premium, I think, on discipline, cost control, and truly diversified sourcing of capital and exits.
Mark, thank you. That's plenty for us and this group to digest. Let's take some of these themes and dive in. You shared that private assets continue to grow and are forecast to nearly double by 2030. Yet we know fundraising is already challenging, despite some of the positive signals that you shared and seeing some tailwinds in that space. Will capital continue to consolidate around a few mega managers and effectively see a flight to quality and bigger names from all investor channels, or is there still room for differentiated mid-market strategies to thrive? Vince, get us going on this.
Thanks, Yegor, and Mark. It's great working with you on this edition of the Global Asset Monitor. Appreciate all the time and energy. I don't look at that question as being binary, Yegor, right? Because there's really two trends. One that's been a long-standing, call it 50-year trend that's going on, and then one that's a bit more short-term. And so to answer the first part of that question about the mega funds. So if you look back, early 1990s here in the US, 8,000 listed companies, right, for people to access as part of their investment portfolio. Today, that number, some put it at 4,000, most put it, just underneath 4,000. But what's happened is there's been a proliferation of private companies that have come to be, and we're talking 19,000 to 20,000 in number. So just that, halving of listed equities and just incredible explosive growth on the private equity side has created much more opportunity, supply, and demand for these private equity offerings. So if you look at the the fact that Mark mentioned the IPO market coming back here, but really, if you go back 50 years and you bifurcate it, the first 25 and the next 25, the first 25 years value creation, significant value creation occurred with the unlocking of the balance sheets via the IPO process, right? You go the last 25 years, the value creation that's taken place privately has far outstripped the unlocking of valuation in the IPO markets. And so just that in and of itself has created this trend to the private equity markets and subsequently the private credit markets, which I know we're going to get into. But that long-term trend, fewer public companies, more private companies, value being unlocked IPOs, value being unlocked as these companies stayed private longer because the access to capital was available to them. That's kind of the big 50-year trend fueling the answer, which is yes to that first part of the question. The mega funds are here. They're going to get bigger. There's actually going to be more of them coming into play because the shorter term trend that also supports it are groups like KKR, Apollo, TPG, Blackstone, right? All going public themselves, accessing the markets. So the trend for investment managers, asset managers, has been to go public, when the overall trend for companies to stay private longer has been going the opposite direction. So we see those companies getting bigger. We see more companies choosing to go public to gain access to capital so that they can put that capital work in doing what? Acquiring mid-size managers for more product offerings, right? Using their equity float to buy as well as some cash, but ultimately creating more of these mega and let's call them next level down mega fund managers. So that's to answer the first part of the question. The second part about or will it be that there is differentiating that can occur in the mid-market fund world for people to survive. That's going to be the case even with this trend happening. There's always going to be a desire for specialized managers, and now that's equity, credit, it's industry sectors within, it's structuring the actual vehicles and what does that look like for particular types of institutional LPs. So I don't see it as binary, Yegor. I see it as being both are actually going to occur, and we're just in the early innings of it.
Very true, and we're seeing definitely a wave of consolidation, but also multiplication of the number of products per manager. Over the last couple of years, that's significantly increased as managers seek to offer a broader range of products to their investors to attract more capital. And perhaps, I guess, we should explore, what are the sources of capital different between the more niche or mid-market specialists versus the mega funds? What is the experience? How different is the experience between those two types of managers? Maybe Liz, you could share some of your experience on that.
It's a good question. And so I think that, as Vince noted, there's always going to be room in the market for the large mega asset managers because you have large investors that need to invest, hundreds of millions of dollars over a very long time frame if you have long-term data liabilities. But on the flip side of that, there's always going to be a need for folks that specialize in the lower end of the market, that are doing smaller deals, that are investing in businesses with enterprise values, 100 million or sometimes even smaller. 100 to 250 is kind of how we define the lower middle market. And the rub in the whole equation is that if a manager is doing lower middle market deals and they raise a fund and they're successful, then people want to give them more money for their next fund and for the fund after that. And so you end up with managers, raising larger pools of capital, potentially chasing larger deals or doing more deals. But there's always, we call it sort of cycling down. There's always going to be the need to kind of cycle back down and find folks that are really good at that kind of, it's, we call it almost, it's a small cap premium, but the folks who are able to invest in small family founder-owned businesses and, generate true differentiated returns.
That's very interesting. And thinking of the different experiences and pools of capital, Mark, you mentioned this, but one topic that we cannot avoid is certainly the democratization or retailization of access to private assets. And we're seeing a lot of RIAs, family offices, even self-managed retirement accounts ultimately edging into private markets. So let's think about that more operationally. What are some of the regulatory structuring and operational hurdles that managers must solve as this becomes true mainstream? And what are some of the options that exist in how to structure and access that capital? Scott, could you get us going on this?
Yeah, for sure. And just touching on how the mega cap managers have grown, they've created structures and vehicles that are conducive to absorbing retail flows, right? So it's not just the largest institutions who have hundreds of millions of dollars to put to work. It's also the high net worth individual who has tens of thousands of dollars to put to work and needs a way to access alternative assets in a low brain damage way, right? In a way that they're not going to get dozens of capital calls and K1 statements and all the frictions that are tolerable for large institutions with staff and resources that are unpalatable for the high net worth or the RIA. So it's putting a combination of a great asset class, but also a great structure that accommodates the preferences of different investor types. So at Ghost Tree Partners, we focus a lot on the RIA and family office channel, understanding the key considerations that are important to them, not just on a structure side, but also on a tax side, on a reporting side, on making sure that our clients, we have a good fit for our structures that we manage, and making sure that that's appropriate for our end clients. So you don't have this constant tension between an investment structure and an LP. So what we have seen in the private credit space has been a big shift in the last 5 years towards more evergreen vehicles, which allow people to stay in the market. What we're seeing from our clients is that private credit has become a foundational part of an asset allocation. So 15 years ago, that allocation was 0. Today, maybe it's 5%. And I think it's growing from here. What people don't like is saying, hey, I have a target 5% allocation to private credit, and I'm investing in a closed-end fund that takes 3 years to call my capital and immediately turns around and sends it back to me. It's hard for an RIA or a family office to hit a target allocation when you've got this constant flow of capital being called and capital being returned. So like one of the big shifts we've seen and we've embraced is a shift towards evergreen vehicles. We manage that in a private fund structure, but there are others who have launched into interval funds and public BDCs as a way to offer liquidity reporting, offer a 1099 to investors, offer maybe allegedly liquidity, and which is something worth considering. Is you've got an illiquid asset class that is trying to be fed to an investor who wants liquidity, and in good times it works just fine, but in bad times there's always going to be the rub. So part of that increase in due diligence that you mentioned as a general trend, a lot of that is going into diligencing the structure, not just the manager, right? There's a lot of maybe confidence that the manager is delivering great loans and great content, but if the structure is not set up to manage liquidity appropriately, everyone still has scars, I know I do, from 2008 when we saw the ultimate liquidity asset mismatch, and people are paying very close attention to making sure the structures that they're using to implement their asset allocation decisions are appropriate for the underlying liquidity of the assets they're looking to invest in.
Yegor, if I could interject too, Scott, right, talked about it, the RIA market, which really wasn't present 15 years ago in the private credit space to remotely the extent it is today, they're looking also for a different level of transparency than the big insurance companies that were there 15 years ago. They were probably the early adopters of private credit, right? Matching of returns and liquidity profiles. So there's a level of transparency, Scott, that you guys provide via your investor letters and dialogue that didn't exist in this area of the private credit markets 15 years ago, right?
Yeah, for sure. And I would even go a step further to say, like, private credit has become this catch-all asset class, right? So private credit 15 years ago was synonymous with direct lending or corporate cash flow lending. Today, we're seeing managers of all sizes lend against various different types of collateral, not simply EBITDA. So we saw this Meta AI $27 billion private credit transaction where you're not lending against cash flows, you're lending against data center and the promise of cash flows in the future. Like, that's a very different risk profile. It's a different type of loan, a different underwriting skill set required, but it all gets lumped in as private credit. And so what we're seeing is that as all these asset classes are growing, there's even differentiation within the asset class. So the private credit of 2025 is not the same as it was in 2010. And that makes sense given the size of the opportunity set to step into traditional bank lending by non-bank lenders. And I think that's only going to continue, right? So when we talked about what it's going to look like in 2030, I think you'll see private credit lenders lending against an assortment of assets and collateral that may look very different from what it looked like in years past.
We're just going to add that particularly the structures have been innovated, and also the access points. Because if you think 10, 15 years ago, if you had your account at one of the large wirehouses and you wanted to invest in private equity, you had to actually manually fill out, or your financial advisor had to manually fill out subscription documents, which I'm not sure if anyone's ever done that. It's not an easy task to do. And so I think there's been a lot of technology kind of coming into the space to enable, 1-2-click subdocs to allow clients to come into these structures. There's now, whole aggregators that would say, all right, if your product is not on XYZ platform, then you can't invest with us. And so I think there's been a lot of entrance to this space to facilitate the ease of access to even come in, as well as, and Scott kind of alluded to this, the different levels of suitability to come into these structures to begin with, right? So, the fact that you used to have to be a qualified purchaser, which at the individual level was 5 million in net worth, I believe, potentially liquid or illiquid, I think mostly liquid. Now that level of suitability has come down to the accredited investor, and then even almost the, everyday kind of mass affluent investor. And so I think that the access kind of points have come down, and then the accessibility has just increased significantly in the last 10, 15 years. And it's providing, just regular people access to an asset class that has delivered outsized returns for institutions for, decades now. So it's, it's democratizing in that way. The one rub that I see is that, I do think that everyone needs to be mindful of, sort of fees and how fees work kind of throughout the chain. But I think ultimately it is, it's a solid trend for the industry.
And to reach, as you say, it is any level of scale and truly open up access to these markets, things like manual touch points across the processes from subscription through to KYC, through to reporting and access to your data, and friction needs to be taken out of this process, which is obviously what, as you said, a lot of players in this market and a lot of providers like ourselves are leading with to create and improve that investor experience, which ultimately is needed to unlock this at any scale. And touching on something you and Scott and you, Vince, all said, we think about the multiplication of innovative, creative, esoteric types of asset classes, which are private credit or not, secured against different types of assets, new structures for the actual funds and access points. Do you see this as sustainable long-term solutions, or are there potential vulnerabilities, right, if the cycle turns? Because if you combine that, and the skeptical view could be if you combine less professional and retail access, innovative asset classes, new and innovative structures, what would it take to prove resilience through a potential downturn, particularly with some of the stories that we're already seeing, with some of the defaults happening and the exposures that managers and investors have to particular asset classes that are very widely reported on. Is this a start of a crisis, or is there a resilience across the stack?
Scott alluded to it in that, there's been innovation in the structures, and as long as things are structured appropriately, and as long as there is a level of sophistication and the investor understands what the liquidity profile is, and if there is an asset liability mismatch, I just think it has to be managed on the front end, from just a kind of investor sophistication understanding standpoint. So it's very important that people know what they're getting into, and how it's structured, and then more importantly, what it looks like when they get out. And that getting out might take several years, just depending on what's going on in the market.
Yeah, I agree with that first part, and think there's more, right? So certainly, how are they getting in? Who's diligencing this, right? As Scott mentioned, there's RIAs in between Ghost Tree and the ultimate LPs, right? And so we could tell you with certainty, right? They are spending a lot of time on Ghost Tree's underwriting principles, and so I think that's the second piece of how these products are being diligenced. What are the underwriting principles? Are those underwriting principles being sacrificed for the sake of a deal, a facility, or a facility in the private credit space? So I think that's Yegor going to always be, regardless of what's going on within the markets, right? What we're seeing in practice is that we're in the early innings. There's people looking at private credit and saying, "Oh, look at this explosion in private credit," but we see it more of early innings maturation. Scott alluded to the global financial crisis, where banks stepped away, private credit facilitators stepped in, and so really over the last 15 years, those groups have matured and are bringing this particular type of product to bear. That they're still working through some of these things that the private equity industry had worked through previously, right? So if you think about it, where a company went public and you're going to issue corporate bonds, now these companies getting bigger and bigger, issuing private debt, right? They're choosing when to access the private equity markets continuously, or are we better served with our balance sheet allowing for private credit to hit the balance sheet, right, versus our equity in the capital stack? That's what the private portfolio company CFOs are dealing with day in, day out, when they need access to more capital for growth or for other things for the business. So capital allocation decisions at these private portfolio companies, which have been growing in size, scale, complexity over the last 25 years, is now leading to the private credit markets, we think early innings, maturing, and they've got a lot of room to go, right? Just the fact that Meta did that deal with the private markets and not through a public issuance tells you all you need to know, right? Because they could have just as easily gone and done that with a public issuance.
Now that said, we work in financial markets, so there's always trouble brewing, right? Like it's anytime you have a non-volatile asset paired with a lot of leverage, you have a recipe for a crisis, right? And whether that comes out of the blue like COVID did, or the GFC, there will be the next one, right? So it's your ability to weather that storm is going to be highly dependent on the combination of factors that go into a particular fund, right? How much leverage are they using? What are the characteristics around that accessibility to leverage? Can that leverage be pulled at an inopportune time? What is the liquidity of the underlying fund itself? Are they going to have to come up with capital at an inopportune moment? Like the devil's always in the details, and a properly constructed private credit portfolio strategy needs to marry complementary elements between leverage, structure, liquidity, and the underlying deals that they're investing in. And usually when you look at all the great blowups, it's when someone's done that inappropriately, where they've used too much leverage on an asset that's too illiquid, and offer too much liquidity. That's the secret sauce for a financial disaster. So I think the private credit industry as a whole fared reasonably well during COVID, right? Like the amount of leverage being utilized at that time weathered the storm pretty well. Will it on the next crisis? Like time will tell. There's always the next crisis. If we've learned anything, there's always going to be a next time. So that attention and focus on those elements today, Liz, to your point, like that's very important and front and center when people are underwriting these strategies.
And I agree with you, Scott. I think the big difference across the last few years, let's say like COVID through to where we are today, is that we actually had tightening of credit underwriting, because what happened, we had rates moving much higher from near zero to 4.5%, 5%. So what we saw happening were roughly 6 turns of leverage inside these private portfolio companies actually coming down, right, and people adjusting their underwriting thesis to something more moderate, 4 to 5 turns, right, because it just got more expensive. We didn't see the spigot continue to keep funding the credit facilities as we did in leading up to the GFC. So it's now with things loosening and rates over at least the last year, clicking down 25 basis points 2 different times. We'll see where they continue to go, but I think that's where the next chapter gets written, Yegor, is okay, do rates come down further? So does credit get made more accessible? That's where I think the kind of the canary in the coal mine will show us the way.
Yeah, and particularly when the investor base expands to include more retail or first-time allocators to private markets, that level of education, right, from all managers and distribution partners will be key to for investors to fully appreciate the nuances of asset classes, liquidity, gating procedures, and all other aspects of private markets if they're truly going to become a feature in a whole portfolio view in a total portfolio construction for investors. So, and maybe focusing in now just on North America and the US as a whole, Mark said the Global Asset Monitor reported that over 60% of all private credit and over half of all private equity AUM is actually North America based. So I guess what lessons do fund managers draw based in the US and globally can draw from that, and how do they access the market?
Yeah, look, I think it's still early on. So I think they shouldn't look at that kind of headline number 62% and kind of back away and say like, oh, I might be too late, because if you use public markets as an analog for private markets and you take public listed equities global and you take corporate bonds globally, right, the ratio is somewhere around 23 to 24% credit to equity. If you look at the global private equity versus let's just call it private credit, that ratio is 10%. So it's not in line with the public market counterparts, right, peers. So we think that there's more room to go even without the growth in the sector, which we are forecasting to happen as well. So we think that for it to just get in line with the public markets, you're looking at a doubling, and then for the growth on top of that. So we don't think that headline percentage should be a cause of concern for LPs.
A lot of it must also depend on the behavior of the banking sector. I think outside the US, obviously Asia and Europe, the banks are still so much more active in the lending markets, and there's a lot of room for private markets to take market share from the banks as they have in North America. I think that also provides that kind of room for growth.
Yeah, I mean, from our perspective, we see in the US, borrowing from private lenders is commonplace. Like borrowers don't think twice about it. Like everyone they know is doing it, so it's a great solution for a ton of borrowers. And also on the LP side, it's not an esoteric asset class anymore. I remember talking to LPs about private credit 10 years ago, and it was like very much an educational meeting. It was like private credit 101. Now, when I meet with someone for the first time, they're well versed. They know the ins and outs. They know the asset class well. Like they're way further up the curve in their understanding of the asset class than ever before. So it has become a household name on the investor side and on the borrowing side. Here in the U.S., I think that those trends will extend to international markets over time. But I would echo, Vince, your comment about it's still early innings, even here in the US, right? So when we meet with folks, it's, hey, private credit, I've got a 1 or 2% allocation that I want to take to 5, right? Like,
yep.
That's still a triple from where we are. And so like, I do feel like every time I talk about the size of the asset class with investors, like every month I've got to update my number. It wasn't that long ago that I said it's approaching 1 trillion. And now, Mark, you're saying it's 1.4 trillion. Like, you know, by October, we're going to have to update it again, it feels like. So it does still feel like early innings, both on the borrower side as well as on the investor side. And I think the trend we see here in the States is likely to extend internationally as well.
Yeah, Scott, tell me if this is fair. I said this earlier today with a group that I was speaking with. Private credit was almost 20 years ago. It was a source of capital of last resort, right? And so it was like, oh, I've got to go get private credit. That meant a bad thing, or there was a stigma attached to it. Now it's, oftentimes thought of, first or second, at a minimum. And so I look at it that way across the past 15 to 20 years, is that I went from a source of capital of last resort to a very viable first or second source of capital for these companies.
100%. And I think today borrowers appreciate the flexibility in terms, structure, creative solutions to provide the kind of capital that they need when they need it, and also when they don't need it, have an ability to pay it back. So I think that flexibility in how we lend to our borrowers is a huge value add that you do, and a timeliness too that you don't typically see from traditional bank lenders.
And maybe taking a step back from me, working with both global, US, and European asset managers, I think these stats highlight what we feel in practice is that increasingly one is either raising capital in the US or deploying capital in the US or structuring one way or the other. So I think managers, given the size of this market and the influence it has on both capital raising and capital deployment, managers increasingly, despite the broader geopolitical trends or potential fracturing of global trade, it's increasingly is an interconnected world of capital flows and capital deployment for managers that we see. Vince, you talked about the overall decrease in the number of publicly listed companies, right? And how many more companies stay private for longer. Increasingly, we see continuation vehicles as a way for sponsors to retain different types of assets and an increasingly viable exit pathway. Do you see this as a sustainable long-term trend? And what issues are you seeing with investors or managers in both or either single asset or multi-asset continuation vehicles?
I see it similar to how kind of private credit was viewed, as I mentioned, like source of last resort. Continuation vehicles previously meant, oh, that's a bad thing. There's a stigma attached to it because it might be where someone's parking something that they just can't do anything with, right? And they've got to move on from the existing fund. Today, from our perch, we see continuation vehicles being created because LPs want more time with the portfolio company. They want to fund more growth at the portfolio company, and they're actually putting multiple like A assets into those vehicles. So I'd be interested to see, Liz, if you guys are seeing similar trends across your manager base.
Sure. I think you're right in terms of the continuation vehicle. I think it's here to stay in terms of an exit mechanism and a provider of liquidity for investors, but I don't think that we'll continue to see them at the scale where they are right now. So if you look at exit activity in 2025, continuation vehicles account for 19% of those exits in 2025, which feels really high. I think that is happening for a number of reasons, where we can kind of weave in the trends that we've discussed here. Is that fundraising is hard, and GPs are needing to generate liquidity to send back to their investors, and the exit markets are just not that vibrant. And there's a whole other topic, but your sort of traditional exit markets aren't really humming on all cylinders at the moment, and investors are expecting to get 10-12% of their capital back every single year. And with the exception of 2021, where it was nearly triple that, we've been at very, very kind of in a low exit environment for the past several years. And so the continuation vehicle market has sort of stepped in, I think, as a stopgap solution there. That said, it has now become, I think, generally accepted by the market that if there is an asset where there is a business need in terms of additional time or additional capital for M&A or for growth, that the market has generally accepted it. I also think that secondary players have come into the space, and there's a lot of capital being raised around the continuation vehicle phenomenon. So I think that it's one that's here to stay. I don't think that they're all created equally. There are certain ones that are for some folks, and some are for not for us. Like we like single asset continuation vehicles that are trophy assets, where you've got strong alignment with the GP and the management team. But to Vince's point, there's multi-asset continuation vehicles that are being created out there that were some investors like those as well. So I think it's here to stay, but it's just probably not at the volumes that we're seeing today. I think that we're at a moment in time when they are very popular, because I do think that they're being used to just send liquidity back to LPs so the sponsors can get their next fundraised.
It's similar to the proliferation, Yegor, of the secondary vehicles as well, right? That's another avenue that has certainly...
And they're ultimately pretty connected, right, in terms of professional investors, secondary investors into CVs.
Yep.
And the other trend we're certainly seeing, and probably underpinning this, is that it's not just about whether it's a trophy asset or a difficult exit, but sometimes, genuinely, given the life cycle of a fund, typically 8 to 10 years, and the investments made that time ago, it's a very different geopolitical rates and overall investment environment. So the investment thesis formed 8 years ago will have changed significantly, and there's a lot more value to create with a new investment thesis tailored to the current macro and geopolitical environment. So more managers seeking to kind of adapt their value creation strategies for those assets with that extra time. So it's an additional dimension to the CV landscape. Well, thank you, Mark, Scott, Liz, and Vince, for an informative discussion, and a lot more detail and viewpoints are available from this group and more in our Global Asset Monitor. Thank you for spending time with us discussing these trends.
Thanks, Yegor. Thanks, everybody.
Thank you.
Thank you.